Market structure is one of the most powerful technical concepts and is a key foundation towards profitability, yet so many traders get it wrong. If you know which direction the day is going to trade, then you are well on your way towards profitability and minimizing losses, minimizing confusion, and minimizing frustration. And the problem is people will bounce around on YouTube videos to try and understand market structure and apply it in the wrong way, either focusing too much on the higher time frame, focusing on supply and demand and trend from the daily or weekly time frame, not realizing that has no effect on today's price action. And some people take it too extreme the other way and focus too much on the 1 minute time frame and end up even more confused and frustrated because there's conflicting information and it's changing all the time. So in this video, I'm going to be giving you a full course breakdown so you can finally understand market structure and start to master it towards understanding the daily bias, the direction of the day's trade, all by combining multi-time frame analysis, which is going to be linking towards points of interest, trend, and connecting everything together from concepts, time frames, and bringing it together with diagrams and chart examples. So here is the market structure blueprint so you can finally understand the correct way to read price action and finally consistently be on the right side of the market. Okay, getting right into it, we can see that in this price action sequence, we can divide it into the main market pushes, and the main market movements are going to be either a bullish expansion, prices rising and getting higher. You can then have sideways consolidation, and then lastly, you can have a bearish expansion, price going down, and this together forms a market cycle. Now obviously this is a simple approach, but we can start to break down each portion, whether it's the consolidation portions or the bullish expansion or the bearish expansion, and when we start to understand what market phase we're in, then we know what we need to pay attention to. So before we break down all the details, the first portion to focus on is the bullish expansion, and this is going to be characterized by a market structure read, which is market forming a high, and then instead of going lower and forming lows, we maintain and we form a higher low. This higher low is higher than the previous low in the market. So basically, the first impulse makes a high. This area respects the range, makes a higher low, which goes on to make a new higher high. The reference points here to remember are going to be the ranges. The ranges are important for overall analysis, and we're going to get back to why this is so important. But when we look at the first push from down here to up here, that first market impulse, that first bullish push, we can mark out the high and we can mark out the low. So long as price respects these levels, we are inside that push. And then when price goes on to break that level by forming this higher low that goes on to make a new higher high, we broke past the previous range, we have now had a bullish break of structure. And once we have found that new bullish break of structure, we have found a new high in the market, a new range. And therefore the previous higher low becomes the new low of the range, and the new higher high becomes the new high of the range. And this is how you'll be flowing with the market. You'll just be finding the range and see what is the push of relevance. And then when we see this respects, forms a higher low, goes on to make a new higher high, new main push found in the market. When this respects and then goes on to make a new higher high, new main push found. And our goal to focus in our analysis and not to look at everything on price action and then everything that's on the left going back months and years. No, we just need to focus on the time frame that we're on and finding the main push of that time frame. This will give us a relevant push, and it will show us who's in control, where they're going, what is the range of that control, and how it connects to multi-time frame analysis, which is what we're going to do in a moment. But we can start to see how chaotic price action can become very clear once you start to realize all you need to look for is the main push, because the main push is structurally relevant and in control, because those are the ones moving price right now. So usually when I mark my structure, I'm just trying to find the higher lows and higher highs in a bullish trend, and I'll follow that up and I'll see prices rising, and I'm going from higher low to higher high, and therefore I see I'm going from higher high to higher low to higher high. Eventually, I'll start to see price no longer makes new highs. It starts to respect a level, and it doesn't make new lows either. It's starting to respect that level. That's when I enter the next phase, which is going to be known as a sideways consolidation. Now, this area is where people get really distracted because they'll try and ping pong inside the range too much, or get confused because they're continually looking to buy, not understanding we're in a range. So understanding the purpose of this is going to help you get clarity, and then understanding the signatures so you know what phase you're in to avoid trading the other phases. Before I get into the sideways consolidation, one quick tip that I want to give you is using the 50% rule. So when I get a Fibonacci, and if I pull the Fibonacci from the previous low to the new high, and I pull a Fibonacci, if I see that the price has retraced towards the 50%, what I mean by this, price go to the previous higher low that goes on to make a new higher high. When it retraces, if it crosses my 50% and then goes on to make a new higher high, the fact that this crossed my 50%, this means this is a valid higher low for me. Valid higher low is only when it crosses the 50% as a general guide. This is going to stop you getting too confused when you see internal price action doing something like this, and then you start to see price doing something like this and pushing up. And you start to see, oh, price has started to go higher over here. This must be a bullish push, not realizing it didn't come to our 50% guideline. So it's going to stop you getting confused on the lower time frame by using a higher low crossing the 50% as your guide to validate if it is a real higher low that goes on to make a new higher high. Using that 50% rule will stop you getting confused and stop you falling for market structure traps. So as we're going through this video, start to realize, okay, market structure is quite simple and it becomes the backbone for every profitable strategy. But the reality is, if you find a simplified edge, a functioning strategy that has been working for me, I've been trading for a decade now, and I've showcased an abundance of proof of the millions of dollars that I've made with a MyFX book, broker sting journal, live call outs for a year and a half where I was calling the market live ahead of time, the before, during, and after, publicly documenting 59.5% gain. And not only that, we've helped hundreds of traders inside of our community get funded and make significant payouts. So if you want to be part of our inner circle, which is application only, where you'll have access to one-on-one coaching and training, live streams every single day, multiple times a day and multiple times a week, group sessions where we have a Q&A to break down your trades, your losses, any confusion you have, click the link in the description for the application and one of my team will reach out to you, and the promise to you is we will leave you better than we found you. Okay, now let's start to explore the next phase, which is our sideways consolidation. Often misunderstood and confusing, but the reality is this price action sequence has a lot of meaning, because usually here you are accumulating to either go higher or to go lower. And the reason for this is price can't go in one direction forever. It needs to pause, accumulate new orders, because people are taking profit and exiting the market and new people are getting in. So there is a new battle that needs to play out and we need to start to understand who is in control. The analogy I like to think of is the market is like a tug of war where you have two opposing sides pulling in the opposite direction. On one side you have the buyers who are trying to push price higher, and then on the other side you have the sellers who are trying to push price lower. Opposing forces, and when the market moves in one direction, that means one person is in control. If the market is going higher, that means the buyers are in control or the sellers are very weak. And when the market is going lower, that's when the sellers are very strong or the buyers are very weak. But when the market reaches this consolidation, sideways price action, this means we are in equilibrium where the buyers and sellers are completely equal and no force has taken control. So what do we need to do? We either need to have more buyers for price to go higher or less buyers for price to go lower. We need to get strength on one side or weakness on another side before price moves in a direction. So this is where the action really happens, because if you can start to see when the consolidation is coming towards an end, that's when the next expansion, whether lower or higher, is about to come, and this becomes a great opportunity to get in because a big move is coming right after. So following the guidelines we previously mentioned, where we take the previous higher low and we draw that as a line, that becomes our low, the low of the range, and then we have our higher high, which becomes the high of the range and becomes the guideline here, and the main push from this higher low to this higher high. So if we start to see that the range high and the range low is being respected, every time price shoots lower, it's not going lower than the range low. It's maintaining a level, sometimes a bit higher, sometimes a bit lower. This is all normal, but we can see that price is failing to break lower, and at the same time, price is failing to clear higher. It's consolidating around the top. Sometimes it grabs a bit of liquidity, sometimes a marginal higher high, sometimes a marginal lower high, but in the end, it's nothing impactful, and therefore we can call it range bound. It won't be pip perfect. It will be a general range. Let's call it a range of 5 to 10 pips. If it's consolidating without intent, it's not going in one direction, you've entered a consolidative phase. And in these consolidative phases, you have to be, number one, careful, because you can't be thinking I'm in a trending market and forcing yourself to buy when the market is not bullish. And second of all is understanding this is an opportunity, because when the market consolidates, it will not consolidate forever. A new trend will emerge. And if you know how to read the details inside, that's when you can ladder in the entries. And if you understand directional bias, you are ready to trade with the trend, with the market. Okay, and now the last portion will be our bearish expansion. This is where we move away from sideways consolidation, which is just maintaining the previous range of the higher high and higher low. And we start to see price does not break the previous high, it's respecting the range. However, it does break the range low. We start to make a new low in the market. So we can see this previous range, the previous higher low has now been broken, and we've now had a bearish main push that has broken past the previous higher low that went on to make a higher high. We have now formed a lower low. So this conversion is important, and I'll write it down to be clear, and I'll define it like this. A bearish market begins where a higher high in the market goes on to break the previous higher low, which made it. So this higher low went on to make this higher high. This higher high now breaks this previous higher low to make a new lower low in the market. So when you have a higher high high go on to make a lower low, that's when you know you've had a bearish switch and therefore a bearish break of structure. So this previous range of the higher low, we can now put it as a bearish break of structure. And you know, after that, we will have a bearish market, especially when the next retracement portion doesn't go on to make a new higher high. It fails to make a higher high and makes a lower high. So this is going to be important. Let's write it down. This not only becomes high probability opportunities, it brings you clarity in directional bias when this area fails to make a higher high and makes a lower high, which goes on to make a lower low. And this is where you've now entered a bearish market. And when we have established that bearish expansion is in control, we start to do the same thing. We look at the previous high in the market that had the break of structure to make a new low in the market. And that's how we start to understand our main push. This high goes on to make this low. So that becomes our bearish main push. When this area, this lower low in the market, goes on to be broken by a new push down, a new lower low is formed. That's when we move our guidelines to the new lower low and moving this higher high to the next lower high. And then as price breaks low once again, we move our range low to the low of the market, and the previous lower high becomes the high of the market, becomes the ceiling of the range. So when we start to see the sequence of lower lows, lower highs, lower low, and lower high, and we've established that bearish market, we once again use our 50% grid line, the Fibonacci, where we pull it from the high to the low, and we see if it crossed the 50%, which it has, then we know it's a valid lower high. And then you can move it to the next one and say the same again. From this lower high to this lower low, this next lower high crossed the 50%, it went higher, so it's another valid lower high that made a lower low. Now, this is a simplified breakdown on how market structure connects with market cycles, and this will be a very simple market cycle where it goes from bullish, consolidation, and then bearish. But then obviously you can have multiple cycles, and these multiple cycles will look something like this, where you can have a bullish market that can go on to consolidate, sideways consolidation, that can continue bullish. So this would be known as impulse, accumulation, impulse. And this accumulation will be known as a reaccumulation. Alternatively, you could have a market phase where the market goes bearish and then it goes consolidating and then it goes bullish. This would be another bearish expansion, accumulation, bullish expansion. Another market cycle we could have is a bearish price action read, could lead to a consolidation, could then lead to another bearish cycle. So this would be bearish expansion, sideways consolidation known as a distribution, and then goes on to make a new low and therefore another bearish expansion. To understand how these market cycles are going to connect, and the way you read it is through the simple principles of higher highs and higher lows, or lower highs and lower lows. So for example, looking at this price action on a higher time frame, the 4 hour, we can start to see that we have these higher lows that are making higher highs. For example, we can see the market has formed this high, which goes on to make this higher low, which goes on to make this higher high, which goes on to make this higher low, which goes on to make this higher high. We are in a bullish market, and therefore we have our ranges, and the ranges can be understood very easily, where we have this higher high in the market that retraces to make this higher low. This higher low is now respected, and then we break past to make this new higher high. So when we break past, we know, number one, this is a bullish break of structure, and therefore the new range becomes from this low to the new high. And once that range is broken, we have found a new main push. And that's all we are trying to understand is, where is the range and who's in control? So when I know that this is the range from this higher low, break structure past the previous high to make a new high, this is the main push. Therefore, I should be trading inside this range, looking for buys because it's bullish. When the new range is found and we form this higher low, which goes on, breaks the previous higher high to make a new higher high, then we know that this is the range we should be trading in and we should be looking for buys. The next phase becomes when the market breaks past lower and forms a lower low, breaking the previous higher low in the market to form a lower low, and then making a lower high that goes on to make a new lower low. We are in a bearish market. And something for you to write down, a new bearish market is formed when a higher high is formed in the market, like over here, that goes on to make a new lower low, a higher high to lower low, breaking past the previous higher low. So a higher high in the market that goes on to make a lower low in the market, breaking past the previous higher low. Once we have found that, we have now found a bearish switch in the market, where now the sellers have taken control. They have won that battle of tug of war that we were speaking about, and now a bearish market is in action. And when we see that this retracement fails to make a high, it actually makes a lower high compared to the higher highs range, and then goes on to break the previous low to make a new low. We have now found a new bearish main push. And that's all we're looking for. We're looking for the bearish expansions or the bullish expansions to find who's in control, and then we trade in that direction. Okay, so once we have understood the framework of the market cycle type 1, obviously there is some other cycles to get more advanced, but what I want to focus on is what we do from here as a step-by-step process. When we get towards a consolidation, range bound, we're going to be going sideways price action. This is usually referred to as noise, but I'm going to show you how we can get a bit more clarity. And then obviously the last one being a bearish expansion defined by lower highs and lower lows. So this is all well and good as a collection, but this is just reading or understanding price. Moving on from that, we want to understand directional bias, or which way we should be looking to trade. If I'm taking a trade today, how do I frame it? That's going to be defined by the main push. Now, the main push is the most important thing to understand when building a framework or a foundation on where to begin your day. So whenever I go to the market, whether it's a Monday, whether it's a Friday, I'm always going to be starting with looking at where is the main push. So let's build a framework and how we can do that exactly with this market cycle type. So to nail the main push, we need to first understand the trend in control. So a few things for you to just write down and define for yourself is when you are in a market where a high is formed and that high fails to make a low in terms of the previous low and goes on to make a new higher high, as we spoke about the external ranges where a previous high goes on to make a new high, leading to a bullish break of structure. This would be defined as a bullish main push, where a higher high is formed that fails to make a low and makes a higher low compared to the previous higher low, and then goes on to make a higher high, a sequence that simply looks like this. When you have found that you are in a bullish market and therefore you have the associated demand areas, which I'm going to show you, and the expectation that the range is going to be respected, where the previous higher low is the floor in price should not breach it, and the current ceiling is the previous higher high, where we expect a new higher high to be formed. So when you have found a bullish main push, you should be looking for bullish points of interest and then be framing yourself to buy. In a bearish scenario, you should be looking for a sequence of lower highs and lower lows, where the lower low is the floor in the market, the previous lower high is the ceiling in the market, and a new lower high goes on to make a new lower low. That defines your bearish main push. In which case, you find a bearish main push, you find the associated supply zones, and you sell in those areas. That is going to be defined by a sequence of lower highs and lower lows, and the range is going to be the lower high is the ceiling, the lower low is the floor. The expectation is the floor will be broken and a new lower low is going to be made. So that's what you call a trending market. When a current trend, a bullish main push is found and you're looking for the continuation of the current trend. Or in a bearish market, you found a bearish main push and you're looking for sells to continue on in that bearish trend. When you're looking for continuation models, that's where the saying comes in. The trend is your friend. Look to continue the trend you see. But upon occasion, you are going to see a new trend forming. For example, you may see a bullish market as we spoke, maybe a temporary consolidation, temporary sideways price action, to convert the bullish market to end up as a bearish market. So that's going to be a new trend is formed where the market went bullish and then converted into bearish. This is going to be defined as a reversal model, not a continuation model as we just spoke. For reversal models, the rule is going to be a higher high goes on to break a previous higher low to form a new lower low. Let's define that. A higher low that made a higher high, that is our current range. And because that is our current range, the expectation is the higher high will go on to be broken and the higher low, the previous higher low, the floor of the range will go on to be respected. Well, in this case, we can see that the higher high is not broken, fails to break, fails to break, fails to break, fails to break, and in the end is totally respected. So this is not a higher high as is expected. In fact, it's a lower high. It's respecting the previous ceiling. And interestingly enough, it breaks the other rule, which is the previous higher low, which was our floor in price, is now broken to form a new lower low. So in this case, a reversal scenario where a new market trend begins, a new expansion begins, is when the higher low, which is the expectation to make a new higher high, is formed. That forms our range, the higher low being the floor, the higher high being the ceiling. The expectation is a new higher high should be made. The fact that this fails to make a high and most importantly goes on to make a lower low, this is known as a break of structure. So when the previous floor is broken, the higher low, and we form a new low, we've had a bearish break of structure. Once you've had that bearish break of structure, you can establish a new trend from lower lows, lower highs, and lower lows. Therefore, you're looking for bearish expansions to look for sells. As we are working together today to build the frameworks, one thing that I want to share with you is in the link in the description, we've prepared for you a functioning, working blueprint that is going to be giving you clarity, further information, and most importantly, tested and verified with my 9-year trading career. With the blueprint below, we're going to be sharing with you exactly the step-by-step process to get you in that right direction. So go ahead and click the link in the description. I don't want anything from you. It's free for the rest of your life. Just make sure you sign up and use it, and let me know in the comments in a future video how it has helped you. The next step is going to be finding the areas of interest. Where is interesting for us to take action. Just because we have a direction in mind doesn't mean we can enter wherever we feel like. We have to find refined, probable areas. And that's going to be the next step, which is defining market structure with points of interest. So bringing this together in a very simple context, when we have a bullish market where we formed higher high, higher low, and then a new higher high. Now, within this market cycle, we're going to understand that the main push is defined by market structure, where we have higher high in the market, higher low in the market that didn't break the previous floor, the previous higher low, and goes on to make a new higher high. Therefore, the main push becomes from the higher low to the higher high. We have now found a market structure shift, a market expansion, and therefore we know we need to be looking for a replication of that move to form a new higher high, breaking past the previous one and respecting the new floor in price, which is the higher low. So higher low to higher high, that's the expectation of the expansion and the trend. But where do we get in? Because we can enter anywhere from this range, technically speaking, but obviously there's going to be optimal areas, high probability areas, and when we refine them, add confirmations, we are well on our way to being consistently profitable. What we need to do here is understand that the fractal nature of the market exists. This is where one time frame is not the truth. In fact, multiple time frames connect together to tell us a story. And therefore, what we'll realize is the higher highs and higher lows we see on one time frame are going to have internal higher highs and higher lows on another time frame. This is the fractal nature or internal trends. That's why you have to do a multi-time frame analysis. So put simply, what we're seeing as a single impulse from higher low to higher high, in reality will have internal price action, where you'll have internal highs and higher lows, and then you have bearish portions in this sequence of retracement, where you have a sequence of lower highs and lower lows. So just because you saw a bearish portion with lower highs and lower lows, that does not mean you are in a bearish market, and that also does not mean you are looking for bearish expansions, because the overall trend is bullish. It's just had a bearish segment, which is why you need to understand what is the main push and what is a retracement. Let me connect that with you by showing you how to interact external trends and internal trends to understand control and bias. So now that I've drawn the internal trends, we can see that we have internal higher highs and higher lows. So we have an internal bullish trend going on inside of our external trend. So let's define the differences of what is internal and external, because if both are bullish, what is the difference? So the first thing to remind ourselves is the external ranges. That is defined by the higher high and higher low and new higher high. So when we see that the previous higher high is taken out, this was a previous ceiling in price, a price respected, and then went on to break. So when we see that price has broken the previous ceiling, we know that we've had a break of structure over here, and therefore the new range becomes the higher high and the new floor becomes the higher low. So this is our external low, this is our external high, meaning the higher high is the external high and the external low is the higher low. This is our main push range. This is what you call a dealing range. Inside of that dealing range, you'll notice, well, there are sections of bearish, internal lower highs and lower lows, and a section of bullish, higher highs and higher lows. So what is the difference here? The difference will clarify where every single push you see, let's draw the range. So for example, here we see a lower high that makes a lower low. Perfect. We're here, we see a lower high that makes a lower low. Over here, you see this low goes on to make a higher high, breaking past the previous high. So when you have sequences of pushes up that are bullish and sequences of bearish pushes lower, the reason that this is not a main push, the reason this is not an external push, and the reason this will not define our overall trend is because none of them interacted with the external ranges. For example, this lower high that goes on to make this lower low, well, it didn't break the floor in price, the external low, the overall higher low, and it did not break the higher high, the external high of the range. It's just creating an internal range. And once we have defined that internal range, we can actually write it down and say this is our internal high and this is our internal low. And we can see that the internal high and internal low doesn't come anywhere near our external high and external low. So it's a trend inside of a trend, and therefore we know this is temporary and not aligned with the overall movement. So let's see what happens next. Once we have found the internal low and we have the internal high, that internal range, what happens next? We have a bullish portion that goes on to form a new high. We break past the internal high and form a new higher high. So we can write that down. We have a new internal higher high. So this is our new internal high, and the previous internal low is respected. So we found a new range and we broke past the previous range. So we can actually remove that because that internal trend is now gone, and we can see that we have a new internal range. The reason it's an internal range is because the previous higher high, that range is not broken, and the previous higher low is not broken. So we can see that we have a completely separate range where our external range is respected and our internal range is internal to that. So it's a temporary internal trend. And the pivotal point becomes, which would define our points of interest, is when we have an interaction between our internal and external. Let me show you how that looks. So for example, here, when you have price forming this higher low, we can write it down as a internal higher low, and we can delete our previous one. And we can see that price goes on here to break past not only our previous internal high, that internal range, the previous internal higher high, not only is that taken out and therefore that is void, but actually takes out the external higher high. We have a full break of structure now and we formed a new high in the market. So let's delete all of the previous stuff because we know that's not relevant anymore. It's pretty clear to see that this internal higher low went on to make an internal higher high, therefore an internal trend. However, we interacted with the previous external higher high that goes on to make a new higher high. So therefore we've had a break of structure, the interaction of an internal higher low that goes on to make an internal higher high, breaking past a previous external higher high. Once that happens, you've had a complete shift and the previous ceiling in price has now been broken and a new ceiling has been found. This is when you have a break of structure, and this is going to be the most relevant zones we need to be focusing on. So this brings me into now how to find your points of interest, the most relevant areas to be focusing on in the market, where we have the origination, the higher low that goes on to make the higher high. That is what we call the extreme. This is the beginning point of the move, where the new main push that goes on to make a new external high, breaking past the previous higher high, where that originates from, whilst respecting the previous higher low range. This is a new higher low that is going to be referred to as our extreme demand, which aligns with our external low, or in other words, our higher low that went on to make the higher high. That extreme portion is known as our extreme demand. So let's mark that out, where we can define a demand area based on that higher low and the external low, and we can call that a extreme demand. This is going to be one of the best places to be looking to buy. Something that you may be aware of is the law of premium and discount. The way I like to look at that is I find the higher low, and that's the low of the range. I find the higher high, that's the high of the range, and I look for where the 50% is. Wherever that midline is, the 50% mark, anything above that we call premium, and anything below that 50% mark we call discount. So this is a PD, a premium discount array, where we've had a bullish push, a bullish expansion. We split it in half, and this is a simple guide to say that we should be looking to buy in discount below the 50%, and we should be looking to sell above the 50% in that premium area. Meaning to say any demand area that is found in discount is going to be highly probable. The other type of demand area we're going to find is going to be that decisional portion. Remember that internal higher low we spoke about that went on to break and form the external higher high, that area that internally interacted with external. This portion broke past not only to form a higher high, yes, but most importantly, breaking past the previous ceiling in price. The previous higher high was the ceiling. This area was responsible for breaking it, and therefore that area is known as a decisional. Before this point, we were respecting the high, but once it was broken, we knew that a new market expansion, a new main push was forming, and therefore the relevant portion of that was the area responsible for it. And this defines the other area for us known as a decisional. So therefore we have found in discount two high quality areas that are relevant because this is the origination of the main push, the higher low that went on to make a higher high. That origination point is the extreme, and then the decisional is the area responsible for the break of structure, responsible for breaking the previous higher high in process of making the new higher high. Both of these areas, the decisional and extreme, become favorable opportunities in terms of demand areas. Of course, inverted the other way around in a bearish market would make high quality supply zones. And therefore, once you have have found the step-by-step process of higher low that made a higher high. You have found a bullish main push. Associated to that, we have found our demand areas. The decisional that was responsible for taking out the previous higher high, and the extreme, which is responsible for the origination of the move. Once we have found that, the next thing you need to do is, for the next foreseeable future, you need to wait for price to arrive to a demand area, and you look for opportunities to buy to go on to make a new higher high. If this area fails, this area doesn't give confirmations or only gives a temporary reaction. For example, price comes in, gives a small reaction, but then doesn't go on to make a new higher high just yet. It continues bearish. This simply forms a pullback, a retracement, where you have internal lows, internal lower highs, and internal lower lows all the way down to our extreme, the next buy opportunity. And when you have found that next buy opportunity, you know now that the retracement portion is complete. You know that retracement portion is complete, where you are forming temporary lower highs and lower lows. And now that you've arrived to the previous higher low, extreme demand area, the external low, you expect that to be respected. You look for confirmations, and you look for price to go on to make a new higher high, respecting the previous external low and breaking past to make a new higher high, breaking past the previous external high. So notice how even in a bullish market, even when you have a bullish main push, bullish expansions, bullish trend, you will still have portions of lower lows, lower highs, lower lows, lower highs, and lower lows. Why is this all fine? It's not a bearish market, it's a retracement. What's the difference between a retracement and a bearish market? Even though both are forming lower highs and lower lows, well, you can see that the external low is respected, where it's forming internal lows, internal highs, internal lows, internal highs, and this is what it's interacting with, where this bearish main push broke the previous internal low. This internal lower high broke the previous internal lower low to make an internal low, and therefore when that internal lower low breaks past this previous internal lower high and then goes on to break the external high, that's when you know you've had a bullish switch, where the internal structure is voided and we now interact with the external structure. So this is how you formulate bullish expansion, bearish retracement, bullish expansion, overall in a bullish trend, aligning it with our demand areas, external structures, internal structures, connecting it all together with the preface and framework that we spoke about at the beginning, which is the market cycles of expansions, whether bullish or bearish, aligning that to trends, aligning that to points of interest, connecting it together to understand market sequences. Now that we've connected all of the pieces of the puzzle together to build a framework just to read and learn how the market moves, the directional biases. But if you want to understand a lot further on how to get clarity, how to take these zones of points of interest and refine them, optimize them, connect it to liquidity, how to find daily cycle variations, how to find lower time frame confirmations, when to be trading, overall trade types, I want you to check out in the description a full playlist that we've made for you, breaking down a full strategy step by step with multiple workshops, masterclasses, and guides to take you from what we have built today as a foundation and building together all the way to a working, tested, functional strategy. So go ahead and click that link in the description to continue further. And as I always say, a restricted trader is a profitable trader.